Hey guys, it's Hi5 Trainer, and in this video, I'm gonna show you the 5 most profitable candlestick patterns that every trader should know. But before we go into the video, please revise my previous video about candlesticks, because to learn what candlestick patterns are, candlesticks are important. So let's quickly revise what a candlestick is made up of for the new viewers. So this is how a candle looks like. A bullish candle is green for its body, so its body is green. And for a bearish candle, its body is red. And for a bullish candle, this is called the body, so the green part, and it's the same for a bearish candle. The red part is called the body, and the open of the candle is the opening price of the candle. So for a green candle, the opening price is at the lowest point of the body, and the closing price is at the highest point of the body. So here's the close. So the open is below the close. And for a bearish candle, the open is at the top of the body, so the open is over here, and the close is at the bottom part, so here's the close. So the open is above the close. And for a bullish candle, there's stuff called wicks. So wicks are basically these vertical lines above the body and below the body. So the vertical line above the body is called an upper wick, and the vertical line below the body is called a lower wick. And it's the same for a bearish candle. So this is called an upper wick, and this is called a lower wick. Now the stuff called the high and the low of the candle. So the high is the highest point the candle has experienced, highest price the candle has experienced, and the low is the lowest price the candle has experienced. So this is the lowest, this is the low, and this is the high. And it's the same for a bearish candle. So this is the high, and this is the low. Now let's move on to the candlestick patterns that we're supposed to talk in this video. Now let's look at the bullish candlestick patterns. The first bullish candlestick pattern that we're going to talk about is called the hammer. A hammer is a bullish reversal pattern that takes place in a downtrend. So imagine that this is a downtrend making lower lows and lower highs, and there's a hammer formation. So this is how a hammer looks like. The body of a hammer can either be green or red, but I'm just gonna color it in as green. Then you'd expect the trend to be going in an uptrend, so in this way. So this, So this is an uptrend, and this is a downtrend. Okay, now the parts of a hammer. In a hammer, the body should be as small as possible. So you should have a small body. One second. Yeah, it should have a small body, and its lower wick should be as low as possible. So this should be as long as possible, but at least, so if the body, imagine the body being 1 centimeter, then the lower wick should be 2 centimeters. So the lower wick should at least be twice the length of the body. Now the upper wick, So the upper wick should be as small as possible, and it's better if there's no upper wick at all. Now, what does a hammer signify? A hammer signifies that the bears, even though the bears pushed the price down to the low over here, the bulls managed to pull the price back up. Therefore, it shows that the bulls are coming back into the market. So what's the theory behind a hammer? A hammer shows that the sellers brought the price down until the low, so until here, but then the sellers brought the price back up to until the high or the open. Therefore, it shows that the buying pressure is coming back into the market, and therefore you'd see an uptrend after that. Now let's move on to the bullish engulfing pattern. So the bullish engulfing pattern is also a bullish reversal pattern, so it takes place in a downtrend, and it happens with two candles. So the first candle would be a small red candle, and the next candle would be a bullish engulfing candle. So it basically engulfs the candle before it. So it's like this. And then what this shows is that there's a huge buying pressure that jumped into the market. So therefore you'd expect the trend to be going in an uptrend after that. So for a candle to be a bullish engulfing candle, the open of the candle should be lower than the close of the previous candle. So this is the close of the previous candle, and this is the open of the next candle, and the close of the next candle, second candle, should be higher than the open of the previous candle. So it acts as if it's engulfing the previous candle. So this is a bullish engulfing pattern. And now let's move on to the bearish candlestick patterns. A shooting star takes place in an uptrend. So think of this as an uptrend, and this is where the shooting star takes place. Oh, sorry. So that's red, okay. And then you'd expect the trend to go bearish, so downtrend, and this is uptrend. So what are the parts of a shooting star? In a shooting star, the body of a shooting star, so this part, the body, should be as small as possible, and its upper wick should be at least twice the size of the body. So if you think the body is X, the upper wick should be 2X. And now the lower wick should be as small as possible. So what's the theory behind a shooting star? A shooting star says that even though the buyers push the price up, the sellers manage to get the price back down, showing that there's a selling pressure in the market, and therefore there's signs of a reversal. Now let's talk about the bearish engulfing pattern. The bearish engulfing pattern is the exact opposite of a bullish engulfing pattern. So it's a reversal pattern that also takes place in an uptrend. So this is the uptrend, and then the first candle should be a small green candle, and then the next candle should be a large bearish candle, so this acts as if it's engulfing the candle before it. So and then you'd expect the trend to go downwards. So what's the theory behind a bearish engulfing candle? So what it states is that even though there's buying pressure, it became smaller, so therefore a small candle. And then there's a large red candle stating that the sellers came into the market, and therefore you'd expect the trend to go downwards after that. For it to be bearish engulfing pattern, the second candle, so the open of the second candle, this is the open, should be above the close of the previous candle. So this is the close and it should be above it. And the close of the second candle should be below the open of the previous candle. So if this is the open of the previous candle and this is the close, it should be below it. Now let's look at the spinning top formation. It's a continuation formation, so it's basically indecisive, so you don't know if the market's bullish or bearish after that. And it generally forms in consolidation. This spinning top formation shows indecisiveness in the market. So a spinning top generally looks like this, with really long wicks and very small body. So this is the upper wick, and this is the lower wick. What it shows is that the buyers and sellers are almost equal, therefore you wouldn't know where the market's going. It generally happens in consolidations. So consolidation is like if a market is going in an uptrend, then there's a period of consolidation, and then it starts to go up again, or it can also go down. So it generally happens in an area of indecisiveness, so you wouldn't know if it's gonna go up or down. The main difference between a doji and a spinning top is that dojis generally have smaller wicks than spinning tops. So spinning tops have a very long wick, upper wick, and a very long lower wick, compared to a doji's medium size upper wick and a medium size lower wick. If you want to know more about this, click on the link in the description below. Thank you for watching. If you like this video, please subscribe and turn on the notifications bell to get notified whenever I upload another video.